Drew Meredith, how are you, mate?
Excited. Pumped.
Pumped. What are you pumped about?
Riding this wave at the moment as we come to the end of the financial year.
Yeah.
I was doing a little bit of Googling, Google Finance. That's where we go for everything important, isn't it?
That's where the truth is found.
I was just looking, it feels like everything that could go wrong is going wrong.
What do you mean?
And it looks like, not much happening. There's Europe, there's the Middle East, there's tariffs.
Oh, yeah. Sorry, I thought you said there was something going on with Google Finance. I was like, oh no.
Every part of our business that we rely on is gone. And I was just looking at, we're looking at almost a 10% return in equities financial year to date.
Yeah. Which is crazy.
I think, and when you talk to people, it does not feel like a year where you've just seen a 10% return. Our model, so our balanced growth portfolios are looking above 11% for financial year.
Wow.
As well.
That's 50-50.
35-65.
Balanced 65-35?
Balanced growth.
That's just more industry fund definition. There you go.
No, balanced and growth.
Just so people are aware, Drew bought Natural Confectionery Company lollies into the office and they're delicious.
I have eaten 2/3 of them myself, but slowly giving up.
You're also very real portfolio. Everything portfolio, the $10,000 portfolio. I've got it here.
I'm looking at a 5% annualized return at the moment.
You're up 2.4%. How does it feel?
Amazing. Yep. Feel like I'm on top of the world. Patience really paid off. I have to thank every member of the team when it comes to this. It wasn't just me that came up with it. It was all those stocks that are contributing a little bit.
Yeah, it's a real team effort.
Yeah. More spread.
Yeah, it's quite interesting, isn't it, really, when you think about it? Tesla's down 24%, so that's probably a bit of a black sheep. But
I was listening to Kathy this week, though, and Kathy thinks it's a 10-bagger from here. She said it was a 10-bagger from where it was 2 years ago.
What's Tesla's stock doing this year?
Tesla down 22%. Against
no, but it's $322 a share or $1 trillion US market cap.
Back over the trill.
You reckon it's going up from here?
10-bag.
You reckon?
If you believe Kathy, yeah.
Yeah, but what do you think?
You clearly believe Kathy. You're buying another Tesla.
Yeah, I'm thinking of it, yeah. People on Twitter, TikTok, they were very quick to remind me that I'm basically the worst person in the world.
They do turn on you quickly. That's when people quit Twitter or X.
Yeah.
Whatever you want to call it now.
No, but they did remind me that I'm a horrible person for wanting to buy an electric vehicle like that.
People seem to be able to visualize what what
Elon
Tusk is saying and dreaming about better than other companies, it seems. Like you talk about Apple and what they're visualizing there, and it's more about how Siri doesn't work very well.
Yeah.
But the cutting edge things that he seems to be doing, whether they become a lightning rod for better or worse. But I was listening to Diary of a CEO, which unfortunately one of our competitors on the podcast charts.
Yep.
And
yeah, that's generous to us.
Put us in that conversation. Kathy was talking about, and it was the same before, where no one thought he was had an ability to create or produce so many cars. He wasn't a car manufacturer, but somehow he's been able to turn that, and he's a massive car manufacturer now. And she was talking about the fact, and you've probably thought about it too, which is autonomous taxis, and that Elon is probably years ahead, and the gap is growing ahead of where everyone else is.
The only little bit of actually that I'll do on today's show is that technically Waymo, which is Google's self-driverless cars, they already have 2,000 cars in the market. In Phoenix and Silicon Valley area, Bay Area and stuff. Whereas technically Elon Musk doesn't have any.
Technically.
But he says that the robotaxis are the future, and he could, I don't know, so here's some crazy idea.
There's someone sitting in the back seat at the moment.
He said there's something like 2 million that could be switched on at any moment or something.
Yeah. That's that's what Kathy's talking about.
Yeah.
Like you could drive your Model Y to work, turn it on to Tesla Uber mode, not Uber, just Tesla mode.
Yep.
And it'll go work as an autonomous taxi all day and earn you money. Probably not much money.
Yeah.
But all those idle cars can be switched on remotely to become taxis.
Yeah.
And drive themselves.
You would have to think that we're no more than 10 years away from that. So even though like cars like BYD and stuff get compared to Tesla for the EV.
You can't do that on the Prado.
They have absolutely nothing on the autonomous side of things. They're so far behind in terms of the actual technology.
Just facial recognition.
Yeah, they just follow you everywhere you go.
Anytime you blink.
Actually, I was in Newcastle on the weekend. Shout out to my Newcastle Knights. I don't know anything about the NRL.
The Blues won. No, they lost.
What do you mean, like in the AFL?
No, the Origin.
Oh.
The Blues lost last night.
In the State of Origin?
24, yeah.
Ah. Well, see, that's as much as I know.
Yeah.
And anyway, I'm a Newcastle Knights diehard. Been for life, guys.
Beautiful spot, though.
Oh, yeah. Lovely part of the world, Derby Street.
Coal mining.
Probably my number one tip for coffee drinkers in Newcastle, and this is going to be so cliche.
Oat.
No, is actually Autumn Rooms on Derby Street. Very popular spot, but I think the coffee is excellent.
Is that down near the beach or is that in the main street?
It's in the main centre. Yeah, I think the coffee is superb, and I think the restaurant culture in Newcastle is excellent. I think the beaches are up there with the best in Australia. It is so nice. So shout out to everyone in Newcastle. Don't know where I was going with that. Oh, yes, I hired a Subaru on the weekend. And it was tracking my face the whole time. I couldn't even look at the Hunter Valley wine region without it going beep, beep, beep. And I was like, oh my, wouldn't it be nice just to put this on autopilot and just look over there?
It does get pretty annoying.
Yeah, anyway, so back to the portfolio. You're looking pretty good across the board, other than Tesla, which is down 24%. Your biggest winner is Pro Medicus.
Surprise, surprise. The one company I've never bought myself, but
where'd you get that
in this portfolio is doing well.
Dizzy Rascals. Now, this is an interesting one.
Thanks to Sam.
In the $10,000 portfolio, we have CBA up 21%, leading the pack. KKR down 21%. Oh, let's not bring that up again. Solpat's up 21% as well because of the merger.
Dispersion here. There's a lot of dispersion.
There's a lot of volatility in this one portfolio.
Big winners, big losers.
But interestingly, Vulcan down 35%.
Interestingly.
Well, I mean, I often remark that it's not an actual investment grade company, but it's fallen a little bit more this week. And we were just saying off air that I probably shouldn't have let that one go through.
No.
So I do apologise to the community. There were a few votes for it. That's why I allowed it to come in. Huh?
Yeah. I mean, it's always been a trading. It's always, whenever you talk about bull markets or trading, Vulcan's always popped up for the last 5 years.
Yeah, it's a bit of a frothy lithium play for people that don't know.
No, but whenever energy now. They started as lithium and they do like they're trying to create geothermal energy.
Oh, I had a company like that called Hot Rock Limited back in the day. I recommended it to my mate Ryan Newman over at the Motley Fool. He blew up all of his money, but I managed to get out before. That's all right, because he gave me a few duds along the way as well. Vulcan announces extension of conditional debt commitment letter. That's from last week, Drew.
That's a lot of words. Can you put that into Gemini and tell me what it means?
Basically, anytime I hear debt in the subject line for an ASX release, I think to myself, that's probably not good.
So they've been given finance, but they haven't used it? Is that what this is?
It's saying that there's been an extension to the debt that they've already been given that the companies, there's been an extended, reflecting the company's revised financing timeline for finalisation of debt agreements in the second half of 2025. I don't know much about Vulcan, but that doesn't sound...
good or bad? I can't tell.
It doesn't sound positive.
No.
But then I jumped onto the Ticker terminal. Shout out to our friends at Ticker. Hopefully new partners on the Australian Investors Podcast, Drew. Ticker terminal. Get around it. It's the best place for data, they say. Well, actually, it's the only one that I use. So
I think it's better than Google Finance.
It's way better than Google Finance. But I asked you just off here, does it actually make any revenue? Like, nah. Does it actually make any revenue?
It does.
20 million. Is that actual revenue or is that like that fake revenue that companies tend to earn when they're in like mining development phase?
Like pre-selling revenue.
Yeah. I mean, it doesn't look...
It's hard to read. Investor presentation.
What about quarterly activities report? Here we go. What's this got in it? There's a lot of words.
Maybe check cash flow.
Oh, God. There's a lot of stuff before the actual things. Is this not cash flow?
No, the one after that. The one that says cash flow.
Oh, that one. Need to get me young eyes checked.
Receipts from customers, 2.2 million.
Euros. That's not good. For a company that has a market cap of 760 million, you bank it on a lot. I've been wrong once before with
higher or lower price of sales than Nvidia.
Well, 2 million euros into Aussie dollars. Let's say that's 4 million clams at 16 million a year. 760 million is 70 PE ratio, 70 price to sales ratio. Nvidia would be higher.
Yeah, probably just.
Is it?
I think so. Maybe Palantir would be higher.
Let's have a quick look. Nvidia, NVDA on the ticker terminal. What is the valuation?
Only 35 times price of sale. So you go.
35 times?
Yeah, so you can buy Nvidia cheaper than you can buy Vulcan.
Which would you take and why?
I don't think this is even a question.
Yeah,
if I answered the other way, I don't think I should be sitting here
this is
anymore.
the crazy thing. So you just said 35 times, right?
Yeah.
This is next 12 months because it's a year ahead.
16 times.
16 times.
Yeah, it's probably...
It goes to show how crazily fast this thing is growing. It's cheaper than CBA. Would you take CBA or would you take Nvidia?
Nvidia.
Oh my God.
Yeah, I know. It is amazing.
It's gone from, in 2020, so 5 years ago, it did $10 billion of revenue, which at the time I thought was a lot.
Oh, back then it was a cyclical chip maker.
Yeah, now it's 131 billion.
Yeah. And it's growing, like when it grows slowly, it's over 30% a quarter, 30% year on year each quarter. It is, and it's, what are the margins again? It's something like 70 or 80% margin. It is it's crazy. I thought this was, we won't talk about Elon Musk too much again, but something popped up. It seems like it was from a while ago, which was talking about putting together 100,000 NVIDIA GPUs, which Jensen Huang says takes 19 years, that the Tesla, for XAI, were able to put together in 19 days.
So they put all those GPUs together for their server farm?
Yeah, exactly.
In 19 days?
All powered by Tesla batteries.
Really?
Yeah.
So the Tesla, wait, are you having me on?
No, I'm not. There's a video on it. I was trying to work out where it came from.
So wait,
Musk, Huang, 19 days.
I'm Googling this now. Musk, Huang, 19 days. Building these two guys talking together?
Yeah, it's like that one when Sam Altman and the guy from the design Apple things went together.
Permitted in the short time that was done. That is like superhuman. And as far as I know, there's only
it's another one of those awkward lunch interviews, isn't it?
Is this like a thing that they do nowadays, these big tech people?
I think it was actually at some sort of Tesla owners meeting or something, apparently. I'm not sure. Something like that.
Trump chose the right guy for efficiency. That's one of the
YouTube comments.
Wait, so this is for their new server farm to power Grok and all that, is it?
Yeah, whatever the AIs are called. Claude, quite good. Anthropic, been using that lately.
Yeah, it's going to be interesting. I feel like we're at the early days of like the browser again.
Yeah.
You know, like when everyone didn't know whether it was going to be Netscape or Chrome browser.
Firefox is still around.
Or even like, what was the other big one at the time? It escapes me. Alta Vista.
Yeah.
All of these things.
Like the Laserdisc.
Yeah, like we're at this kind of moment in time where I don't think it's truly possible to determine which AI model is going to win for the average human. And that's really interesting because then I think about like different frameworks to invest in that. You could invest in the whole market through like index funds or tech funds. You could own a little bit of shares in all of the big providers, which I think is pretty reasonable. I think no matter which way you cut it through, you've got to have exposure to who might win.
Yeah. Or you just buy crypto like everyone else.
Yeah, but that doesn't really have much to do with AI, does it?
No, not at all.
So, yeah, I just think that's like, wow.
I found that super interesting.
So it would normally take what? Like 2 years?
4 years.
Normally take 4 years to put something like that together.
Yeah.
And they powered it with Tesla batteries.
Yeah. This is why, you saw a couple of weeks ago as well that nuclear energy is taken off again because they're starting, like Meta is starting to talk about having nuclear plants.
Yeah, they're talking about
to power their data centers.
Yeah, they're talking about buying and paying to reinstall all these nuclear sites just to power the data centers.
Because it's so more consistent and already constructed. Like all these things are things you never would have thought of 4 or 5 years ago in public, our government, no, not that I'm pro-nuclear, but the political challenges around different types of energy are clear that like politics is very difficult to change the trajectory of these massive things, but private companies just overnight bang.
Yeah. Yeah, wow. It's quite fascinating, isn't it? That how the heck does that guy, not to gloat about Elon Musk, well, not that guy. Yeah. Does he ever get out of that leather jacket?
No.
It's Jensen Huang. But
I think it's just all GPUs put together.
How does But how does that happen? Like, how does Musk find enough time in his already pretty busy day?
I don't think his days are that busy. He's not doing board meetings. He's not doing compliance committees. He's not doing remuneration committees.
But
I reckon he was plugging. Do you plug GPUs in?
Probably.
I think he was plugging GPUs in himself.
But instead of like doing SpaceX, Starlink, Tesla, what's that other Neuralink?
He's plugging in GPUs.
Boring company. Doge. How is it even possible? He must have like this Illuminati around him that are just like the people that you don't know about that are like the most amazing
I'm sure
people ever.
But they sort of talked about him being on the floor of the car manufacturing facility for like a week or something, like sleeping in the facility, trying to work out where the issues were.
Yeah.
So like obsessively trying to fix problems within any process.
So it's funny. I won't say.
He probably had 4 million people doing it.
I can't reveal much about what I'm about to say, but someone was sitting in this seat last week where I am right now.
Not me.
Not you.
Oh, good.
Sitting in this seat last week that was asked to head up one of the Doge committees.
That's fun.
On behalf of a rep of old mate. And I thought it was anyway, I can't say much more, but it was really, really interesting.
Joe Aston?
You mean the journalist? Just reporting from the inside. Chairman's Lounge. Captain's blog. Love Joe. Anyway.
I dropped in what I thought was a pretty interesting chart that popped up on LinkedIn today.
Give it to me.
Maybe it'll be in the show notes. It is dimensional, and we know if you've heard of dimensional before, it's a bit of a
big fund.
Science-based investing, a bit
quantitative strategies.
There's a word people use for it. I won't use that.
Dimensional.
But the data is very good. It's like a lot of it is rely on the market. Whether that works in short periods, who knows? I thought was super interesting, and this only goes for about 45 since 1980, so that's 45 years. The ASX has returned 11% on average.
When's this? 46 years?
45 years, yeah.
Okay, yeah, got it here.
2025 this year. Yeah. So it's on average, the ASX has returned 11%. That's why all these, whenever you look at an Instagram post, something about compound returns, I'm going to get 11%, 11%, 11%. It has only returned close to that average on 7 of those 45 years. So it's like, what's that? Less than around 1/7 of the time, it's actually returned close to those averages. So more often than not, it's returning either significantly more or significantly less. If you have a look.
Yeah.
The highest is as much as 67. The lowest is as low as 39%. Just kind of, and I think it's important when we're in markets and conditions like this as well, that it feels like I've talked to people that have invested for themselves the last 3 years, and it feels like they think they've done well, but you couldn't have done anything wrong really. Just being invested and you went all right.
Yeah.
But it's more of a reminder that it isn't 11% every year. We're not, just because we got 10% again this year, it's hard to prove against that. It's actually being close to average. It's more than likely going to be above or below that average every single year.
Yeah. It's a cool chart. Who's that from?
Dimensional. Yeah. Big US scientific trading firm.
Yeah. I remember I went to a lunch one day. I sound like a right snob. Went to a lunch and there was some PhD who was up for a Nobel Prize that was brought out to talk about some strategy. And I was one of only like 6 people in the room. And I feel like, I hope someone else asks a question because I don't know what's going on.
That's often the case. You just pre-position a question with something they've already said.
Yeah, that's it. Yeah. I think a lot of the folks in the office, the old stockbrokers, are really good at that. They kind of like wrap up the question and then ask the impossible question.
It's a comment.
And then the person that's hosting, it's like,
hey, what about Trump? Always put that and then you'll be fine. I'll give you 10 minutes.
Yeah.
So Santos got a takeover bid?
Yes, from Middle Eastern Wealth
Abu Dhabi?
Abu Dhabi.
Yeah. That was super. I mean, that business has been, I remember when the share price was like $15.
Yeah.
It's been in the doldrums, but it's rallied a lot, and they had big issues with their debt when they were just trying to get a couple of assets off the ground. So super interesting. A lot of water to go under the bridge for that one.
Or oil.
Or oil under the bridge. Well, it's FIRB. It needs FIRB approval to. I think it's got a 20% holding limit on the business locally. And I saw Challenger had some big shareholder turnover as well in recent weeks.
Why is that?
I think Daiichi, is it Daiichi?
The Japanese.
One of the big groups took out the ownership stake of the other group, and it's gone up to about 19.9%. So right on that cusp of having that share price has been doing pretty well. And then, geez, retail. How do you feel about retail at the moment?
Not very positive. If I'm being honest.
Yeah. I mean, some are positive. Uniqlo, Patagonia.
Yeah, they're pretty good. It's winter.
But apparently not.
Really?
Kathmandu smashed this week because autumn was so balmy.
It was. It wasn't much winter, was it? Yeah.
So all the Kathmandu vests have only just shown up along Collins Street in Melbourne this week. Usually they'd be out a bit earlier. We
have some clients that run their own retail companies, and they have said that, how hard it's been the last 6 months.
Yeah.
Because it's been too hot.
Yeah. Very tough. But you saw, Kathmandu, massive downgrades, Setai, I don't even know how to say it.
Yes, Setai.
Chatia.
Yeah.
Down to an all-time low at the moment, or like a multi-year low, just a couple of downgrades after downgrades.
Let's bring it up on the ticker terminal here, Drew.
I kind of relate it to the, CTT, what do you call the portfolio? Right? The Rascals portfolio.
Yeah, what about it?
Like, I think this is the risk and I think there's a question on it this week as well. This is the risk of investing direct into smaller companies, whether it's direct into smaller companies or direct into companies at all, that you're going to experience significantly more volatility and potential for volatility.
Have a look at that revenue chart from Satire.
Yeah, when it starts at zero, it's every
but
chart
it's gone up to
good.
700 mil turnover. Obviously, it's a retailer, so
that's
it needs
revenue.
It needs more than...
You need to look at what's the margin. As the margin
operating margins went from 4% to 7% to 0 to negative 13 to 4 to 2.
So that's the money that's how much money they make off of that dollar of revenue.
Yeah.
Which is not much.
So, yeah, their net income is shaky.
Woolies makes 6 to 8%, but Woolies has significantly more scale.
And more, a lot more volume. Yeah. I mean, the share price is, oh dear.
Yeah. It's a Head and Shoulders?
Yeah, maybe. Twin Peaks, maybe? It's not looking good.
Twin Peaks.
It's just not looking good for Satire.
The zeitgeist of TV shows. Here we go. I was looking for a new TV show.
Market cap for Satire of 120 mil. I remember when, I don't want to throw anyone under bus here, but I think the CEO or something did sell out quite a few shares a little while ago. And I remember people reporting on it saying that it was maybe a bit of a red flag at the time. And so I think for a lot of people, there's been some interesting changes of share ownership. What's that thing there? It's a hedge. Cat Rock. There's been a few material changes recently. Interesting. There was actually, I had some questions for you actually.
Yeah, I saw these.
Let me get these out.
What else?
Oh, here we go. Yes. This is a question for you. Drew, should anyone under 55 have any bonds or defense in their super fund? Anyone under 55, should they have any defensive assets?
It depends.
I need a hat for that.
And I've been saying I've been working on that forever, but I haven't been working on it. I will start working on it perhaps this weekend. Mm-hmm. I don't think just an age determines whether you should hold bonds or not. That's like saying you should have as many bonds as your 100 minus your age as you get to whatever that rule is, the opposite.
Your age in bonds.
Yeah. Or something like that. I think the inclusion of bonds, which are just a low risk investment that offer diversification and income, should be based on what your objective is. If you've got $10 million and you only need $200,000 a year, then you can get 4% from holding government bonds. Yep. So why wouldn't you hold them if you're 40? Like, what's your objective? Do you want to aggressively grow your capital, or do you want to balance income and growth? So I don't think there's any reason and any simple age rule that you should have in there. But another thing I'd probably say as well is if I think you have to make a distinction between things like cash, term deposits, and bonds. And my view is that if you're going to hold cash for a long period of time, like 5% in cash, you may as well have that in something that's doing more than cash and isn't just floating rate.
Yeah.
Because any bond should give you, if it's a fixed rate bond, it'll give you a consistent income when you bought it. It'll give you some level of capital stability. I know the people who held them during interest rate increases don't think that happens, but it does in most, all but that one period in the last 50 years. And they also give you some protection should markets fall at some point. So I think to me, it's going to be about the optionality that holding a diversifying asset can give you, even if you want to invest at some point in the future.
Okay. Do you think the old rule of your age in bonds, so for people that are listening...
Is it like 100 minus?
So that would be for stocks. So your age in bonds, if you're 20, you have 20%. If you're 30, you have 30%.
Which is 20% at 20 is a lot.
Yeah.
Yeah.
I just feel like at 55, you've still got you've got 5 years. So maybe it's at
35 years of investment.
Yeah, but until retirement, and you need the passive income. Yeah, I agree with you. Okay, I just wanted to stress test you. Next question.
Where do these questions come from? Are these from ChatGPT?
I just think I think of them every week for you. I just think of like what's really thought-provoking. Do
we need a segment name for this?
Deramith Answers.
Oh, I thought Owen's brain farts.
These would be described as the rational thoughts. So how much of your portfolio is in small caps right now?
Maybe send a vote through on which of those names people want as public as possible.
Let us know in the comments or write into us, courtesy of Druid.
You can only vote in emojis.
How much of your portfolio is in small caps right now?
My portfolio models. So the portfolios we recommend at the moment, I reckon there's somewhere between 5 and 10% in small caps of the whole portfolio.
Yeah.
And at the moment we split it between there's global and there's Australian small caps. And pretty much I'd say 99% of that is in an active fund manager.
Okay.
So in Australia we have 2 funds. One would be smalls, one would be micro. And in global we have like a small and SMID. So small and medium-sized companies.
But that's in like the 65-35?
And they're like in a 65-35. And they're satellite holdings. So if you ask how much I had in large caps, it's more like 25 to 30%.
What do you mean?
If you ask me how much I have in small caps, it's 5 to 10% of my portfolio. If you ask how much I have in larger companies, by definition, it would be higher.
But then how much? But that still doesn't add to 65. What's the other stuff?
Real assets and alternatives. Yeah. Oh, what's this? Is this new?
Yeah, these are new allocations. Yeah. I'm just trying to figure it out. I think in our 70-30...
Martian?
Yeah. ATech is like... I should know this off the top of my head. I think it's 5%, which is mainly small tech companies. But VA, it's not really. It's got like zero and stuff in it. It's not true small caps. It's a bit hard when you run listed portfolios
to find all the tools. Yeah. Well, you can get the index, but then as we know, you get the falling knives.
Yeah.
And the rising angels. Maybe it's the other way.
Yeah.
You lose the good ones, you gain the bad ones.
Yeah.
Generally.
Yeah, whatever you said.
But I think reasonable exposure. So that probably says that each holding's about 2.5% of your portfolio.
Yeah.
And you add up 4 of them and it gets close to 10%. And that's something you can swing. I find small caps interesting because I've met a lot of small cap managers over the years and the story is always the same, which is that they traded a discount to large caps and the companies have outperformed. But for the last 3 to 5 years, all I've seen is large and mega caps outperform. Small caps have done well, but large and mega caps outperform everything. So it's hard to keep telling that story when mega caps just keep dominating. And why do we put them? Because the companies are growing quicker and because they offer diversification away from Magnificent Seven and Elon Musk. Some
people say, don't invest money you might need in the next 3 years.
I thought you were.
End quote.
Confucius?
A part of me, Drew, feels like this is a pretty stupid idea, provided people are diversified and use ETFs from most asset classes. What I mean to say is, you know that old cliche of don't invest money that you might need in the next 3 years?
Yeah.
Do you reckon that's a bit conservative?
Are you assuming the market's going to do 11% every year?
I'm assuming that people have a diversified portfolio. So some bonds, some cash.
Even if they're below 55.
Even if they're below 55. Yeah. So say like their 70-30 portfolio at 50, I feel like it's a little bit conservative because most people do already hold cash.
Most people. I think what concerns me here is that when people have a fixed need for capital at some point, I'd probably say a year to 2 years. If there's a specific need they have, is it buying a boat like yourself? Is it a new car? Is it a deposit on a house? And there is that it's going to happen and they need it. I'm always wary that why would you take any more risk than you need to if that is an actual need that you have for that capital? And you need to invest in shares on historic, at least because the volatility that comes with them. It is a 5 to 10 year commitment if you really want to get the best out of it and not suffer from a year of poor returns as soon as you invest. So I think if you have a fixed requirement, I'll be putting aside capital for that. And then the other part is making sure you've bucketed money away. So I think this comes into having a strategy, not just into asking whether you should invest it. I think and there's so much of an expectation that every time you put money in, every time the market falls, you're going to make money. You'll be fine. Yeah. You'll always get 10% every year. And that doesn't happen. I was talking to a client that's been through the GFC, everything today. And he's basically like, it's crazy because every time the markets fallen, you did it perfectly a few months ago now. You bought on the down day. It's recovering quicker and quicker every single time.
That was a fluke, by the way.
Yeah, I know. It's like, but the more that happens, the more it is positive reinforcement that it's always going to bounce back. And like we were talking about the GFC, it started falling in November 2007. It didn't hit a bottom until March 2009, and it never reached that point again until I think 3 years ago.
Yeah,
like it took 15 years to get back to where it was prior to the GFC, or longer, 17 years.
Yeah.
So it can be, and this is why you need to, I think it's about having a strategy, not just about not putting money or putting money. If you have finite needs, then make sure you've allocated something towards that. And yes, put the rest to growth.
Yeah. Amen. Turns out I also bought WiseTech at that time.
You're making me have an opinion. It's
good.
Refreshing, isn't it?
I think it's good, yeah.
I usually lack opinions.
I can just sit back and watch. Yeah. No, it's I also bought WiseTech. I'm up like 30% on that, which I'm very happy about. I didn't expect that to happen.
Credit to you.
What I didn't buy was Costco because I just didn't get around to pressing buy.
How's Costco gone?
Mate, Costco is
great place, by the way.
You know,
are you a member?
Yeah, I
only joined a couple of weeks ago.
Really?
Yeah. I went to, this could be interesting. This could
next
be
you'll buy a Tesla.
I went, I took a surprise date night to Costco.
Mitch from our team.
Yeah.
Our first date was at Costco.
Yeah.
He was crook. He had like
shopping.
Gastro up the
hill.
hill.
Get the pizza and the hot dog.
Yeah, we went down and had a hot dog. He was so sick. So he just sat there and watched me eat a hot dog.
I've never seen a bigger smile on a Costco card. First date idea. Amazing.
But it's awesome. Do you know Costco? I think Costco, we worked this out the other day, is like the 13th biggest company in the world.
Yeah.
Or something like this.
As big as the warehouses.
Look at that. It's up.
That's pretty amazing.
It's up 13, 14,000%.
And they make all their profit from memberships.
Yeah. Look at that.
And they got a good system.
In the last year, the shares are up.
Bring your own 13%.
Bags. Yeah, don't even. Just
giant car park.
Yeah.
Buy more than you need to for most things. Like no one needs a kilo of Nutella.
Yeah, you do.
Really.
Yeah, you do. You need 48 cutlets.
Is this a budgeting thing? It's on average like 30% cheaper for most for like.
Well, technically, I would say the math works out that Aldi is cheapest.
Yeah.
But if you want good quality stuff, Costco's not about cheap, it's about value.
Yeah.
That's their phrase. And I think like if you use the Kirkland home brand from Costco, it is excellent.
Yeah.
Absolutely excellent. No shade on Aldi. Great. Aldi's great too.
There was a bit of shade at it.
But Costco
is know what to buy there.
I don't think it's really worth it unless you're like, you've got a household, like you got kids and stuff. Yeah. Like I think
washing detergent.
Yeah.
Pay off. Like nappies.
Yeah. Nappies huge. Yeah. Gosh. Yeah. Costco's by far the cheapest, even cheaper than Amazon from what I've found.
Chili oil.
The founder, Ron Vakras, he was originally, I believe he was originally working on the floor and a forklift driver. He's been with Costco for like 35 years or something.
Yeah. And now he's CEO.
Yeah, now I think he's earning half of what his predecessor earned or something. It's really, really cool culture. So that's a wonderful, wonderful business, but I did not buy that. But actually looks like I could because it hasn't done much since, it's up maybe 10% since March. So anyway, We do have some questions sent in, which we should get to, Drew. Any of the questions that we do answer on the show are strictly general in nature. We don't know your needs, goals, or objectives, so do not rely on the information. Do not act on the information until you've spoken to a financial advisor, like say Drew. It's important to understand that if we talk about super funds, ETFs, managed funds, they're all products under the financial services law here in Australia. That means they come with a product disclosure statement. So please refer to the PDS before you invest or acquire a financial product. Past performance, not indicative of future performance. This next one is an absolute doozy, and I was going to do a full email write-up about this, Drew.
I think you need to, because
it's because it's still in a state of flux, as far as I'm aware.
Yeah.
So
I tried to put some notes in here.
This is from Big Beautiful BS, which is in relation to the Big Beautiful bill that's currently going before the US Senate, which there's some stuff buried in there, which I can probably riff on for a sec. The question is, can you explain, under the Big Beautiful Bill proposals, the Section 899 tax on investments held by Australians in the US? I currently pay a 15% tax on US dividends, but then claim a foreign tax credit for this from the ATO. Does the new bill mean that if the US increases this to 20 or 25%, I will still only be able to claim a foreign tax credit of 15%? Are there any implications for capital gains? So I think this is going to require a lot more research because the bill is actually quite significant. The genesis, or so it is told, of this part of the thing, part of the proposal of what's going before the Senate in the US is that effectively the government of the United States says that there are unfair treaties against US interests abroad.
Read tech.
Technology, tariffs, proposals, all that sort of stuff. So this is another way for Trump effectively to impose something on foreigners benefiting from US everything.
Yeah.
And
it's like we tried to tax Meta in Australia.
Yeah.
Yeah.
And I think one of the things that this is kind of going to do is just it's a big bargaining chip for Trump and the administration in the US to basically say to countries like Australia, well, you guys have a PBS. We don't want you to have the PBS, because they've said the US government does not want Australia to have a PBS. They want the US pharmaceutical companies to come into Australia and operate under their own terms.
And charge what they want. PBS
exactly.
basically caps the price.
Yeah, because PBS in Australia can be the only buyer of medicines.
Yeah.
So that means that the pharmaceutical companies can't shop around, can't use their influence. They have to sell to the government.
Yeah.
And obviously the United States does not like that because they have a very different thought process of healthcare, I think it's fair to say. So those are the types of things like the AUKUS submarine deals. These are the types of things I would, in my very naive opinion of this, would suggest is where this policy was actually aimed at, is to say, well, here's a bargaining chip. If you don't do a bit more of what we're saying, well, everyone that's in your country that wants some of our country is going to have to pay more.
You're setting up like a change in tax law, but it'll likely be overwritten by tax treaties at some point, is what you're saying. Yeah.
Exactly. Just like the current withholding tax. So they said that this person in the question said they currently pay 15% tax on dividends, but that's only because of the tax treaty between Australia and the United States.
It's actually 30 is withheld.
It's actually 30, but they fill in their W8 Ben form.
Yeah.
And then they claim the foreign tax credit.
So they're only paying 15 withholding tax, which is still better than, the same as superannuation, but better than. Yeah,
but you would still pay, there's still allowances, my understanding is if you don't pay enough tax, it's still equalised here in Australia.
Yeah.
You get the ATO gets its pound of flesh.
Apparently this could increase that withholding tax rate from 30 to potentially up to 50%. And then it's going to be up to those credits. And that would hurt returns, obviously. And apparently there's a target of it is the big super funds that are investing into these companies as well. As always, I wouldn't be reacting too much to it. And that's why, the US market's not going to move because of this. They might be
it's interesting
big in Australia, but we're not that relevant overseas.
No, we're not relevant at all to the US stock market as a whole. But the big super funds here in Australia, including the Future Fund, I think I'm not speaking out of turn, came out, I think I read an article this week or last week to say, we're not sure what the implications of this are yet.
Yeah.
So we're halting any additional investments. And I could be wrong about that. Let me just...
No, I'm pretty sure Future Fund or one of the other big beautiful bill. The Future Fund, interestingly, also got approved to now invest internally as opposed to have to use managers.
Here we go. So this is a speech from Future Fund Chair, the Honourable Greg Combay. who says, the big beautiful bill, in particular section 899 of the bill, will potentially and dramatically escalate tax rates for Australian institutional investors like the Future Fund. In combination, these policies and dynamics are making the US a more risky and uncertain investment destination. End quote.
I mean, some of these, I'm sure they invested in Russia at some point too. So it's not like, it can be a bit of hyperbole, like an increasing tax rate against what's very, very low tax rate at the moment. Most of these things can be navigated. But they're basically saying they'll pause new investments, not sell out. I think that's important too.
I think if you're Australia's biggest virtually sovereign wealth fund, you have to say something like this.
You'll be okay. You probably set up a local feeder fund or something, it'll be fine.
But I think you have to say something.
Yeah.
Right.
Because
otherwise if you don't, then who else is going to say something?
And I thought...
so in summary, I actually am mindful of this.
Yeah.
Over a 10 or 20 year period. It's kind of like this, the unrealised gains tax thing. It's not
slippery slope.
Yeah, it's not necessarily where it is now. It's where it could go. Like I copped some absolute bloody dribble on X yesterday.
I'm sure you did.
What was this one?
Did you know the Future Fund could only invest into fund managers, via fund managers?
Oh, really?
And only this week they managed to overturn it to now be able to invest in their own individual companies or buy airports themselves rather than using a fund manager to do it.
Oh, really? I didn't know that.
Yeah.
Huh.
So they're allowed to internalise like every major super fund in Australia.
4,885 people voted on this poll. Do you believe that a tax on unrealised gains is a fair way to generate government revenue? 83% said no, it is not fair. Now, these come courtesy of...
It was 96 when I voted.
These come courtesy of Mr. Jeff Wilson, by the way. I was blowing up my phone. Hey, Jeff. Then I went on to say, if a tax on unrealised capital gains were introduced in Australia, how likely would you be to reduce your holdings in startups, smaller cap companies, or high growth companies? So if it was introduced, 67% of people said they would be extremely likely to reduce their holdings. 20% said it wouldn't really make a difference. And the final question was, if a tax on unrealised gains were introduced, how would it affect your willingness to hold investments for 5 years or more? 64% said significantly less willing. 28% were indifferent.
I think it hurts illiquidity and people who want to take more risk earlier in their life. Yeah. There's cash flow when you're younger if you're invested in illiquid investments. I mean, does that mean like us investing in our own business? Like, do we have to then value...
Well, we own shares in our own companies.
Does that mean we have to value that and we have to pay tax on that?
I feel like it would.
Yeah, at some point.
But I feel like that's the whole problem.
But it's not audited. Like it's you'd have to audit every company valuation.
But I feel like that's the problem here is that we're in a situation where...
What would you do with your 12 investment properties?
If you were someone that's created a business and you're at this point, you'd be like, oh, I won't do it anymore.
Yeah.
So, it's
a slippery slope argument.
Yeah. And I'm probably in that camp of slippery slope because I just feel like it would be easy for them to go from here to, if no one really opposes it, to then just do and tax something else. There was a few interesting comments. People said like, there's already an unrealised gains tax on land, which is called rates. But rates is not really unrealised. It kind of is. And there's another one which is, what's the thing everyone's been going up at? Land tax.
Yeah.
Like land tax is kind of like something like that. It's not really on the gains. It's just really on the value. So I think it's interesting because I think it's a sign of what's to come. Okay, probably got time for one more question. TermPlus. Is it safe or will I lose my money? So we recently had Nehemiah Richardson back on the show to talk about TermPlus. Given it's new, my financial planner is advising against it. He thinks it's too good to be true. That's coming from Len Terms.
Yeah.
Len Terms? TermPlus? I don't know. So we recently had Nehemiah Richardson, who's the CEO. So obviously always read the PDS before investing in anything, especially anything Rask related. No, but read the PDS. Don't invest in something.
Anything that's like this is not against anyone, anything that's heavily advertised.
You're just against advertising?
Yeah.
Okay.
Like it's not comparison or anything like that, but I find anything that's heavily, not just once or twice, but if you feel like you're seeing it everywhere, I'm always read the PDS.
Yeah, so this just
not avoid it, don't do it, like just read the PDS.
Just so you know.
Product disclosure statement.
So I actually, after I caught up with Nehemiah last week, he's the head of private credit. I actually invested in it.
So basically what it is, it's like it's private credit.
Yes, it's private credit,
which means it's lending your money to companies, global companies, essentially.
Yeah.
Usually directly to companies. Maybe usually that would be bilateral.
This one's via a feeder fund.
Or a fund where they pull all this money and they lend it to other groups, and that's why you return. It's like if you think about a term deposit, you're lending money to a bank in return for a fixed rate of interest. In this case, you're lending it to a pool that is then being lent out to multiple, not to an actual pool, but into a pool, and it's being lent out to multiple companies overseas. That's where the higher return comes from. But naturally, there's higher risk with that. Like there'll be a range of credit ratings, a range of businesses, a range of terms. So it's just private credit that's been simplified for retail.
Yeah,
audience. So
it's basically like exactly what you just said. You create an account, and what you're investing in is the pool. It's the master fund.
The loans will come in, loans will come out, and that money in that pool will be reinvested during that period. But the key, like the thing with these is always the return you can get from anything like this is capped. It's capped at that interest rate. And what you can lose when you're making loans, not just to this investment but multiple others, is your capital. If someone defaults, that's the risk of this. They have protections in place. I'm sure they went through it in the episode as well.
But this is just the Pengana. I can't remember the actual underlying fund name, but
TermPlus.
Yeah. No, but so it's Pengana's fund underneath. So it's called TermPlus, but that's just the platform. It's the Pengana like master something or other. And it's a diversified fund. And Nehemiah, we put all the community's questions to him recently, and it was really, really good to hear him talk about it. As always with these things, don't invest more than you're comfortable with, or any at all. And I think it's just an interesting way for people to explore private credit. So definitely, have a look at it by all means. But if your financial advisor is not comfortable with it, maybe just see how they go. Yeah. Asking them a few questions, see if they get comfortable with something like that through time. There are plenty of other options. Like we're coming across a lot of people that have listened to this show, Drew, and have used the Invesco Senior Secured Loans Fund.
Yeah.
Which I think is a great fund.
Yeah. Doesn't mean it returns positively every year.
No, exactly. But I think it's a great fund, and it suits some people's appetite for risk, and that's fine. All right, probably got time for one more question. Not Declan says, so can you talk more about how to get exposure to private markets to hedge against what seems to be a trend of good companies not listing on global exchanges in the same way that they used to?
Well, one is the private credit way we just talked about, because when you go private markets, same as every other market, you've got equity and you've got debt.
Yeah.
So that fund you talked about is private debt.
Yeah.
And there's multiple ways to talk about that. I think the real benefit of private markets is being truly private and illiquid and difficult to access your money once you invest into it. Unfortunately, there's only a very small amount of investments available to mum and dad retail investors, and most of them are listed.
Yep.
And because they're listed for an unlisted asset class, they're just not perfect. They don't give you the best expression. I know you talk about this all the time, the best expression of private markets. So what we'll tend to use either essentially unlisted, just managed funds from some of the world's biggest private equity players. So Hamilton Lane, I think you've met with, that we were talking about a few weeks ago. There's groups, and most big fund managers have a private markets division. You probably had Neuberger.
No, we haven't.
At different points.
Yeah, but that's a good one.
They also do credit as well. And there's this trend of...
We had Invesco.
Yeah, exactly. They got their own private markets. And there's a trend of historically you had to lock up 7 to 10 years. There's what they call evergreen products have been being made available to mum and dad investors, so people that we work with. And that's where there's a small amount of liquidity on a quarterly basis. You shouldn't be expecting to use it, but they're more accessible and more investable on that basis, that if something really bad happens, like for us, the only time we're changing it is on death or separation or something. We're expecting to hold that for 10 years.
Yeah, that's a good point.
So they are growing, and there's a long list of managed funds. Unfortunately, most of them limited to advisors.
Yeah, advisor only. There are some funds that you can get off the shelf, and that tends to be the ones tend to be the ones that end up on this show, because I don't necessarily just want to bring you funds that you can't invest in. So that's obviously sounds pretty about right. So get in touch with us actually via the Rask community if you want to find out more about the different types of funds that might be available. There are plenty available, in different formats. There was a final question, just a bit of housekeeping from Paul, who said, what is the good research discount code? So that's for Luke Laradif and Ben Richards. The coupon code is Owen. I just checked it. I thought it was Rask, but it's Owen, Owen, Paul. That's over on Good Research. We don't get anything from you signing up. However, they have become a sponsor of the show in recent times, which is great.
Fantastic.
Okay, so great questions from Declan. Not Declan, Paul, Skibidi Sigma. We didn't get to your question, but it was a great one. Len Terms, Big Beautiful BS. And I actually had some pretty good questions for you, Drew. If you want to get in contact with Drew here, his email is drew@wattlepartners.com.au. There was a wonderful piece of feedback in here that said, Drew, don't stop laughing.
We need a theme song.
Costco is a highly recommended good investment, not the shares, the actual supermarket membership. Yeah. Check it out. Let us know what you think. We'll be back next week.
And a date venue.
And yes, you can go and you can get refillable Pepsis. And whatever you do, don't get 7-Up or Mountain Dew from the Costco refills. It's syrup based and it is, oh my gosh. They also do some wicked pizzas, by the way. They're have you seen them?
Yeah.
Yeah, they're huge. Like a metre wide.
Yeah. Let's get a giant bag of popcorn and walk around with that.
Yeah, if you buy cutlets, you get them by the 50. Well, Drew, this has been heaps of fun. We do need your dad joke.
I do, and I feel like this one might hit it quite well. I've been watching a lot of the AI Yeti videos. Have you been watching those at the moment? I'll send some to you.
Okay.
So it's like Yeti AI in real life situations. But which bear is the most condescending?
Don't know.
A panda.
Oh. Well, thank goodness you brought in these yummy lollies for us today, Drew. We really appreciate your time, and thanks for the dad jokes every now and again. And all the best for the second half of the year, might I say, on your portfolio. Your $10,000 portfolio is up. It's leading the pack, 2.5%. The Dizzy Rascals portfolio is also in the positive. Mine is slightly negative. You're in the money.
Yeah.
Watch G-Gus come rampaging on the home straight.
Yeah, I'm not confident.
It is going to come through and everyone's just going to be like, wow, what a genius. Well, I hope so. Praying. Mate, as always, absolute pleasure.
Good to see you.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel, or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.